The recent V-shaped recovery for spot silver and COMEX silver futures prices is now near completion. The silver spot price now threatens to again pass 20 fiat Fed notes per troy ounce, perhaps next week. Now is a good time to remind ourselves about the last time we saw the spot silver prices crash and then rebound under a simultaneous retail and wholesale silver bullion shortage era. It was during the late fall of 2008, right in the heart of the global financial crisis. A quick look back at how things played out last time the silver spot price did a 5x multiple in fiat Fed notes under 30 months of time. Silver bottomed with a London silver fixed price of $8.88 an ounce on October 24, 2008. By late November 2008, QE1 was announced. Silver ran back to the range it was trading in prior to the global financial crisis by middle 2010, only to then rocket out of its sub-$20 threshold in late summer 2010. By November of 2010, QE2 was launched and silver ran past 25 per ounce up to 50 by late April in the following year, 2011. Now let's look at just how much tighter and faster this recent recovery has been for silver versus back then. Between the Federal Reserve's recently ballooning balance sheet and their melding with the U.S. Treasury to the tune of $4.54 trillion in SPV bailouts using the 1934 Gold Reserve Act and the ESF, the silver spot price rebound of 2020 has occurred at about twice the speed as the QE1 version. In less than half a year's time, we've witnessed over $7 trillion in viral bailouts ongoing. The scale of this bailout dwarfs QE1 and 2 combined. Silver should have plenty of upside fuel once the next breakout finally gets ripping to the upside. Stay tuned. Hello, this is James Anderson of SD Bullion. Welcome to this week's SD Bullion Market Update. Smash the like button so we can get more like-minded sound money savers stacking prudent bullion positions before precious metals get exorbitantly expensive. Late last week, Nick Lyard, the purveyor of one of the world's top precious metals price chart websites, goldchartsrs.com, reached out to me by email, and by chance he confirmed exactly what I had been looking at only a day or so prior, late last week. The email he sent me was this: a yearly gold price chart covering this full fiat Federal Reserve note currency era, now nearly 5 decades in age. We both agree it conveys tremendous power about this building gold bull. Now bear with me for the next few minutes as we foreshadow what is likely ahead for the fiat Fed note gold price chart by looking at other major fiat currency prices for gold, starting with the fiat euro. The full fiat British pound, which at one time was 12 troy ounces of silver, it's now seeing record nominal gold prices on the regular. The once supposed safe haven full fiat Swiss franc, breakout. Supposed resource-backed fiat currencies are not looking too resource-rich versus gold these days. Here are the Canadian neighbors to the north and our Aussie friends down under. Swinging over to the land of the rising sun, and we see a bull breakout of epic proportions, last 2 years of time. And finally, we're ending with the largest gold stackers of the world. First, we have the Chinese fiat yuan seeing record gold price highs now on a regular basis. And next, the Indian rupee is off and running with record gold prices. And now for all you silver bulls out there in India and watching around the world, note that the cup formation of this Indian gold rupee chart, which was built from 2011 into 2019 breakout, we have a similar cup formation now building for silver and Indian rupees as well. It looks like we can expect a breakout in 2021 at this pace. Now turning back to the price of fiat Fed notes and silver in 2020, when we finally do get a secular bear market in the fiat Fed notes value, this silver cup should finally form too, with a likely breakout to outflow afterwards. Just about this amount of silver bullion bars reportedly went into the world's largest silver ETF in one day alone late this week. In the chart below, at the bottom, you can see how many 5 million ounce or more blue bar chunks have been going into SLV since QE Infinity was announced on primetime television. Backing out to back when supposedly SLV bought their starting silver hoard from hard asset Warren Buffett's Berkshire Hathaway in 2006, we can see how unprecedented the silver bullion inflows into the ETF have been of late. Just 2 weeks ago, we drilled into all the inflows of silver bullion going into the largest ETFs of late and how that pace has been sustained over the last 2 weeks. Just have a look. Over 33 million ounces have inflowed since. Basically, 6 of these rooms. For a friendly reminder to our new and old viewers out there, we'll leave a link in the comments below describing some key differences between unsecured stock shares and silver derivatives like ETFs versus owning silver bullion outright. The article published in mid-2019 illustrates the key differences between the two distinct silver plays. While the derivatives may be okay for short-term swing trades, we suggest that silver bullion safety and recent premium upside arbitrage are exactly why owning a core silver bullion position outright makes good historic sense. Now turning to the COMEX silver futures market, this chart shows us the recent and unprecedented spot versus COMEX futures market price divergences, both in the gold and silver markets, especially since the viral economic shutdown. And ending this week, some of the COMEX silver futures contracts are already trading at over $20 an ounce. And to end this week, silver bullion bull Scott Menard was on Bloomberg paying a recent visit, reiterating that this stock market bubble could last longer. Though recall, he's on record stating that the S&P 500 should dip below 2,000, back down toward 1,500 at some point. But the underlying foundation of all this bubble that he talks of is built on a pile of debt-laden sand. Have a listen.
Now, one thing that you've been worried about, and you've talked a lot about, even when times are good, is the over-leveraged corporate sector. We're not in a typical recession right now. It's artificially induced, and there's a lot of stimulus here that's pushing back delinquencies. When things do start worsening, what do you think the trajectory will look like? Will it be suddenly and then all at once?
Well, I mean, Scarlett, that I think it's hard to predict. I think we're going to go through a continuing slow erosion. One of the most troubling aspects over the last 6 months is that in order to stabilize the bond market and then subsequently also to lift asset prices like stocks, we've issued over $1.5 trillion worth of corporate debt. And if you had talked to me in December, I would have told you that we were already in a corporate debt bubble. That was, to me, and I think it is very clear, by every metric we have, whether it's actual total debt, debt to GDP, debt to free cash flow, corporate America has never been this levered. And that was true in December. And $1.5 trillion later, which is more than all the bonds issued in the prior year, we're making, I think, a lot of companies even more vulnerable by lending them money when they ought to be trying to pay down their debts.
Yeah. So how do we get out of this cycle? Because typically when insolvency risk is rising, companies should be trying to deleverage, but we just keep getting more debt, as you mentioned. Where do you break the cycle? How do you get companies to start deleveraging?
Well, I think it will ultimately take some sort of severe setback, a surge in defaults. I mean, that is one way to get debt down, is just to default. And I'd like to remind people, Scarlett, that the strongest economic expansion on record was between 1933 and 1936. But yet we never recovered back to the levels of 1929. And then ultimately there was a second setback. That is what resulted in what we call the Great Depression. So, this artificial stimulus being created by the government, by monetary policy, in the near term, is lifting asset prices. But when you look at Main Street, you look at small businesses, these are where, the majority of American jobs reside. The real economy is not improving at a pace that would support, a continuation or cash flow growth, which could support these companies.
Yeah.
So whether that's tomorrow that the chickens come home to roost, or whether it's 3 years from now, the day of reckoning will come. But for the moment, my bet is that monetary policy will remain loose enough to continue to drive risk assets higher. and it's probably for people who are looking to maximize returns, probably the best thing to remain long at this point.
So when it comes to the real economy and preparing for that wave of defaults, we've heard from banks this week who have set aside a combined $28 billion from Citigroup, JP Morgan, and Wells Fargo. I want to get your read on these provisions. Are these carefully considered amounts, or are they stabs in the dark as to what the potential damage could be?
I think they're stabs in the dark. I mean, it's really interesting. At the end of the first quarter, when we had pretty good visibility at the end of March into how severe the downturn was, the banks didn't take very high reserves at all. Now they're taking reserves, a lot of reserves, and that's telling me that they're actually behind the curve and that they're in a game of catch-up. I don't think the reserving that occurred in the second quarter is adequate in terms of what ultimately will be needed. So I think we're going to probably continue to see lots of loan loss reserve provisions going forward for the rest of the year.
Yeah, we may just surpass the numbers seen in the great financial crisis.
That's all this week. We wish all the very best to you and yours out there. If you enjoyed this content, be sure to give our video a thumbs up. To keep getting bullion-related news and industry insights, be sure to subscribe to our channel. Finally, hit that alert button so you know when we publish fresh content. Give us your thoughts in the comments below. Let us know what you think and which topics you want to hear more about.